Canada's Big Six banks just released their 2024 Q4 earnings. Who are the winners? Who are the losers? And more importantly, who didn't raise their dividends? Hold on to your seatbelts, folks. This is going to be a good one. The Canadian Big Six banks dominate our financial system. With those massive market caps, they pretty much act as its backbone. But their influence doesn't stop at Canada's border. These financial giants have carved out a significant international footprint, and those global ventures are bound to play a key role in their growth story. In fact, for one of our banks, the international stage may have been their kryptonite this time around. In previous quarters, we have seen the banks stocking up their loan loss provisions in anticipation, of course, of a big wave of pandemic mortgage renewals. We are no longer in a waiting for the wave phase. It has already begun. 2024 marks the initial phase of that renewal wave. And so far, for the most part, the banks have handled it quite well. Luckily, this wave is staggered, so it does give some breathing room for the banks for sure. They have taken a more proactive approach, offering blended rates, term extensions, or interest-only periods in some cases. All of this, of course, to help ease that payment shock. Still, overall, mortgage servicing costs have risen, increasing the risk of borrower stress and, well, potentially elevated arrears down the line. Keep in mind, the initial part of this renewal wave is folks who took their mortgage in 2019 and early 2020 before those rates hit rock bottom. The rate increase shock for them is still there, but it's not as bad as what is to come. Many Canadians who locked in sub 2% or sub 3% rates in 2021 are not yet at that renewal stage, and they will be the true test of the bank's preparations. As we move into 2025, we will begin to see some of these lower rates coming up for renewal. Most of the sub 2% are in 2025, and then the wave will peter out in 2026 with the remaining sub 3%ers. The Big Six have shored up their balance sheets in anticipation of this renewal cycle. Over the past year, they've increased loan loss provisions and tightened underwriting criteria to ensure new borrowers, as well as those renewing, can handle those higher interest rates. So far, this stance has helped maintain credit quality, with arrears and defaults remaining pretty much contained. I will add that if the Bank of Canada continues to aggressively rate cut, that will also help the banks accommodate the wave of renewals and hopefully help them keep those defaults down to a minimum. A sub to the channel is the best way to prepare for a wave of future content. In just a moment, we will look at the main highlights of those Q4 earnings. Overall, most of the banks performed very well in the quarter, and we have some great numbers to show. There is one exception, as one of the banks had a few issues south of the border that reverberated into their numbers a wee bit. So without any further ado, let's do this. We will start with Scotiabank, ticker of course BNS. When it comes to earnings, Scotiabank was expected to come in at $1.60 per share. They came in a little bit short of that, $1.57 per share. On to the revenue, they were expected to come in at $8.63 billion. And yeah, they missed that as well, coming in at $8.53 billion. They do get an overall fail on these earnings, but they are still looking good on the year. Now, in regards to their dividends, they are still at $1.06 a share. That's a yield of 5.371%. So this is the one that did not increase their dividend. However, this was not a surprise, as they did previously announce that they were not going to be raising their dividend this time around. Switching to their earnings growth, that is expected to come in 8.59% per year over the next 3 years. If we use a discounted cash flow model, we do get a fair value for Scotiabank of 101.83%. So that does paint them as being undervalued by 23.1%. Looking at that 1 year forecast, analysts are expecting Scotiabank to be coming in around $80.58 at the end, not the end of this year, but in 1 year, and that's a 2.9% increase. Scotiabank should still grow over the next quarter, but I do see a little bit of a slowdown as more mortgage renewals begin to filter in. Also, keep in mind, they are still stabilizing their fundamentals after that big $2.8 billion purchase of Key Corp back in August. I will also add this is also a key driver for why they missed expectations. Next, we will look at Royal Bank. When it comes to earnings, they were expected to come in at $3.01 per share. They beat that, coming in at $3.07. On to revenue. They were expected to come in at 14.72 billion. And once again, they did beat that, coming in at 15.07 billion. So they do get an overall pass. Their dividends sitting at $1.48 per share. That's a yield of 3.321%. They did raise their quarterly dividend by 6 cents per share, so that's not too shabby. Their earnings over the next 3 years are expected to grow by 3.01% per year. Looking at their fair value, that comes in at $254.05. That does paint them undervalued by 29.3%. If you look at their 1-year forecast, they are anticipated to come in at $184.93. So that is a 3% rise. I got a feeling they might actually do better. Royal Bank had another great earnings call, and they are doing very well indeed. I'm expecting Q1 to be much of the same, though those mortgage renewals may slow them down a wee bit, but it's still full sailing ahead as far as I'm concerned. Up next, we have TD Bank. Their earnings were expected to come in at $1.80 per share. They did miss that. They came in at $1.72 per share. On to the revenue, they were expected to come in at $12.47 billion. Now they did beat this one. They did come in at $12.53 billion. Unfortunately, they still get an overall fail. Even though they did beat on revenue, this stock has suffered big time for sure. Their current dividends sitting at $1.05 per share. That is a yield of 5.55%. Now, they did increase their dividend by 3 cents. So their earnings growth, it's actually on the high side, 11.89% per year over the next 3 years. Their fair value, that's coming in at $163.51. It does paint them as being undervalued by 54.7%. This next part's a little impressive. Their 1-year forecast is coming in at $87.86. So that's 18.70% of potential growth over the next year. The fines for those money laundering charges in the US hit to the tune of $3 billion. And this, as well as public perception, hit TD hard this quarter. The good news is that they will bounce back on the other side of this. And as those analysts believe, that could result in a lot of growth over the next year. I do agree, but I think there is more pain before we see things turn around. Up next, we have CIBC. They were expected to come in at $1.78 per share. They blew that out of the water. They came in at $1.91 per share. Their revenue was expected to come in at $6.51 billion. Once again, they did beat that. They came in at $6.62 billion. So they do get an overall pass this quarter. Their dividends sitting at 97 cents per share. So that's a yield of 4.112%. This is the biggest dividend raise this time around, 7 cents per share. Their earnings are expected to grow by 6.05% per year over the next 3 years. Looking at their fair value, using, of course, a discounted cash flow model, we get $159.24. That does paint them as undervalued by 41.3%. This one's interesting. Their 1-year forecast is $93.25. So that's actually a drop of 0.3%. I don't know if I agree with that. CIBC did have a good quarter, and I think they will stay strong. But you do have to suspect that growth may slow a fair amount over that next quarter, as they may be due for a small correction. Nonetheless, they have been quite impressive thus far. Up next, we have the Bank of Montreal. Their earnings were expected to come in at $2.38 per share. They came in at $1.90 per share. Their revenue was expected to come in at $8.37 billion. This one they did beat. They came in at $8.96 billion. They do get I'll call this one a mixed fail. They did beat on revenue, and they performed much better this quarter compared to the previous quarter. So definitely improvements right across the board. Their current dividends are sitting at $1.59 per share. That's a 4.347% yield. They also increased their dividend by 4 cents. So that's not too shabby. Their earnings growth is projected to come in at 19.12% per year over the next 3 years. Looking at their fair value, that comes in at $228.67, painting them as being undervalued by 38.9%. Their 1-year forecast is coming in at $136.23. So that's once again, it's a drop of 2.50%. I have a feeling that they're going to do better than that. BMO missed on earnings, but they really did have a much better quarter. And I suspect they will do fine in the next quarter. But I do think there will be a lot of pain later in the year with that mortgage renewal peak. Finally, for the big six, we've got National Bank. When it comes to earnings, they were expected to come in at $2.57 per share. They just beat that by a wee bit. They came in at $2.58 per share. On the revenue side, they were expected to come in at $2.94 billion. They beat that as well, coming in at $2.99 billion. They do get an overall pass, though I do put as a side note, they were a little closer to estimates than last quarter, but still a pass. Their dividends come in at $1.14 per share. That's a yield of 3.315%. They did add another 4 cents to that dividend. Their earnings are projected to grow by 14.60% per year over the next 3 years. If we use a discounted cash flow model, we get a fair value of $227.14. That does paint them as being undervalued by 40.5%. Their 1-year forecast, not bad, $140.50. So that is a 3.90% rise. National Bank continues to do well, though this time they were much closer to expectation. And while investors did punish them a little bit as they dropped with their earnings call, nonetheless, National Bank is still looking good, and I think their next quarter will reflect that. So let's check out their total returns for this year to date. Here is a cool graphic showing them all in comparison to their share values. However, I do like to add in the dividends, so let's look at those total returns. All right, coming in at number 6, we got TD Bank with their negative 4.91% total return. Oh boy, that money laundering definitely kicked them hard. At number 5, we got Bank of Montreal, looking respectable, 27.96% total return. Number 4, Bank of Nova Scotia or Scotiabank coming in at 37.62%. Coming in at number 3, we've got National Bank coming in at 45.09%. So they slipped from number 2, and that spot was taken over by Royal Bank with a 47.21% total return. At the top of the heap, once again, is CIBC with a 69.00% total return. That's not too shabby. As a bonus, let's take a quick peek at a few of those smaller banks and see just where they come in with their 1-year total returns as well. Coming in at number 3, we've got EQ Bank with a total return of 28.75%. Number 2, we got Laurentian Bank, a total return 29.13%. And at number 1, Canadian Western Bank, their total return sitting up there at 89.84%. Keep in mind, this number is still inflated from their impending sale to National Bank. We will be back here after the next quarter and do this all over again. As usual, if you are interested in any of these bank stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on Canoe EIT. Thank you for watching, and I will see you in the next video.